We heard there from Maynard saying, get ready for a 10% correction. There's also Julian Emmanuel from BTIG saying not just a 10%, but he could see a 20% drop as well. This seems like it's starting to become consensus that we're going to see a sell-off and a correction at that. Are you in the same camp? Could we see a decline of 10% or more in these markets?
Good morning, Danny. No, I mean, look, the bottom line is that I think near term we're still going to be all clear. My concerns are a little bit more around 2022. I mean, if you look at the three pillars of support that still exist, which support equity valuations, namely monetary support, fiscal support, and vaccination rollouts, all of that really lays the foundation for supportive risk-taking environment. You add on top of that things like travel restrictions starting to abate. You look at other things like the high savings rates, the ability for consumers to go out and actually express some of that pent-up demand. I still think that in the short term we're in a favorable risk-taking environment. Having said that, looking out into 2022, one of my big concerns is the fact that we could start to have to deal with a specter of tax hikes in the world's largest economy, namely the United States.
So if you think, Gregory, there's still more gains to be made this year, where are those opportunities? In which markets do you see the biggest opportunities right now for the end of year?
Okay, I mean, in terms of one of the things that we have on in terms of our multi-asset portfolios, we still have a favorable view on financials and energy, and it's something that we got early on in, and we did profit nicely. Recognize that it's been a little bit of a sideways trade, and in some instances over the summer there was a little bit of volatility, but we still think that there's juice in that. Energy, commodities, inflation all feed into that. We've got the prospect of a little bit of tapering. I'm sure we'll talk about expectations for the Fed, which should hopefully feed into the prospects for making money in financials. And of course, then there's the prospect of potentially getting in on the leisure trade. So those are some of the positions that we've got in the book at the minute.
So energy, financials, potentially leisure. Gregory, I'm wondering how that call shifts and changes. If it is indeed in 2022 that we start to see higher taxes, how will that impact your investment thesis and asset allocation?
Okay, but I mean, Danny, I have to say, I mean, we have been, very bullish on markets over the course of the past year or so, and I'm always thinking about what could potentially be the fly in the ointment. And it's true, we do have unemployment schemes, support for unemployment starting to taper off, especially in the United States, and also here in the UK with the furlough scheme ending. We are facing the prospect of tapering across the major central banks and the quantitative easing programs, which we benefited from. And of course, there's the prospect of tax hikes. So I think in the near term, I think there's still room to take risk. I just think in the medium term, all of a sudden it becomes a lot cloudier.
So near term, it's all clear to take risk. And obviously, we've got the big event risk of the FOMC tonight, and you may not have met quite so near term as that. What exactly is the message that's going to come out of the Fed, and how is that going to support the market?
Right. Okay. So just a few thoughts on the Fed. In terms of, I think there's a big risk that they actually miss the opportunity to announce tapering. I think there is high expectation that they come out and they clearly telegraph what their intentions are. And my guess is that would be a schoolboy error if they didn't follow through on that. So I think, generally speaking, it's well telegraphed that they're going to engage in the tapering, and that's going to kick off this side of Christmas. Realistically, in terms of the dot plot, that's not something I really pay too much attention to. I tend to think it's a little bit too much of theater. I always jokingly say that a lot of the Fed officials don't even know what they're going to be saying 2 to 3 weeks out in advance, never mind 2 to 3 years out. But generally speaking, I do think tapering's on the table, and I'd be very surprised if that was pushed out, regardless of some of the noise in the market, like the Evergrande story.
I was going to say, I mean, we've seen Goldman, TD recommend some trades to their clients about preparing for more hawkishness, especially when it comes to the dot plots. But Gregory, I have to wonder, with $120 billion in purchases from the Fed, what exactly are the direct effects on the economy that are necessary that would change if some of that has started to be taken away?
Okay, I mean, I think you're spot on. I mean, one of the things that if the Fed asked me, what our advice in terms of the tapering strategy would be, my general advice would be, why don't you start with MBS and then move to USTs later? The U.S. housing market, we all know, has been red hot. Mortgage market's been strongly supported by Fed mortgage buying. And ultimately, part of their mandate is really around financial stability. And so what we don't want is we don't want increased financial instability because of a red hot housing market. So with tapering, probably we start to see a little bit less support in the housing market. So refi numbers, volumes in terms of housing, that could certainly decline. And that would be, par for course.